All right. Well, hello, greetings, and welcome. So glad that you could join us today for our SVDX webinar. For those of you new to SVDX, my name is Nancy Easterbrook. I'm Executive Director of Silicon Valley Directors Exchange. We're very glad to have you with us today. If you are brand new and haven't seen any of our sessions, I encourage you to go to our website. We have a wonderful list of past webinars and sessions that we welcome you to view. Today's session, Private Companies in Corporate Governance, featuring two of our most favorite speakers, will discuss, as the title indicates, private companies in corporate governance. We want to give a special thanks to the University of California College of Law, San Francisco, who is co-hosting today's event. Per our other webinars, this will be a 1-hour session. We encourage you to please submit your questions throughout the session. Please don't wait until the end. We like to fold them into the conversation, so don't hesitate to pop your questions into the Q&A feature, and I will feed those to the moderator and panelists throughout today's talk. For those of you who are familiar with our programs, you will recognize both of our panelists today. We are delighted they are joining us. They have such wonderful insights, and I know this will be a very interesting conversation. I do want to make a plug for both of them. They both produce wonderful podcasts, and here at SVDX, we love to share great resources. So I will put the links to both Evan and Heidi's podcasts into the chat. I will also send it out via email after today's webinar. I highly encourage you to check both of them out. With that, I will give very brief introductions, and then we can get started on today's webinar. Evan Epstein is the founding executive director of the Center of Business Law and adjunct professor at the University of California College of the Law, San Francisco. Evan is a corporate governance expert and has advised founders, executives, directors, and investors for over 17 years in Silicon Valley and internationally. He is the founder and host of the Boardroom Governance Podcast and the Boardroom Governance Newsletter. Heidi Roizen is a partner with leading venture capital firm Threshold Ventures and serves as a board director for privately held portfolio companies Upside Foods and Polar. Heidi is also a member of the board of directors of Planet PBC. Over the last 25 years or so, Heidi has served on over 40 boards, both public and private. In her spare time, Heidi teaches the Threshold Ventures Fellowship in the Engineering School at Stanford, where she is an adjunct lecturer. You can hear Heidi on her newly released podcast, The Startup Solution. Our moderator for today, Dan Siciliano, is a successful technology CEO, founder, and entrepreneur, and recognized expert in corporate strategy and governance. He is vice chair of the board of the Federal Home Loan Bank of San Francisco and currently chairman of SVDX, board member of the Latino Corporate Directors Education Foundation, chair of the Council of Federal Home Loan Banks, and a fellow at Stanford University. And with that, I say thank you to both Evan and Heidi. Dan, please take it away.
Great. Thanks very much, Nancy. Welcome, Evan and Heidi. Super excited to have you here. I love the fact that we get to turn the tables. I get to ask you questions instead of you asking us questions. But I know that we're going to have really fun conversations. So again, we're going to talk about the governance of private companies, probably with a disproportionate focus on the director role and the independent director role, which is an emerging and hopefully dominant concept that's changed over the last decade or two. But I want to kind of kick it off with an ever so brief. I want you to tap your inner law professor, Evan Epstein, and give us just a very quick touch point about an answer to the question that goes something like, wait a minute, isn't the law for corporations that are private, isn't that like really different maybe from the law that governs public companies? And when I ask specifically, let's think about private venture funded or high growth companies that are formed for the purposes of getting big out of Delaware law. So how different or how similar, or maybe even identical almost, are these different corporations governed by Delaware law, Evan?
Yeah, thanks. Well, thank you for the invitation, Nancy and Dan. And so I was happy to be back here and talk with SVDX membership and other directors from the region. The law, at least from the state perspective, is the same, right? It's based on Delaware, or if you incorporate in another state, it could be California, it could be any of the states in which you incorporate. Now, Delaware is the most used state law. However, what does change is that once you're a public company, you do have to follow regulations from the SEC and other federal regulations and stock exchange rules, which changes the dynamic of the board. So board composition, for example, when you're a public company, requires a majority of independent directors. You have to have a certain number of committees of the board that are 100% independent. There are some exceptions if you're a controlled corporation. And so what happens is that you have a very big difference between the composition of boards and public companies, where the vast majority, if 85% of directors are independent in the S&P 500, and that doesn't happen in private companies. And the reason for that is because the theory is that in a public corporation, when you have dispersed shareholders, you need to have some level of monitoring, of oversight, because at that stage, the CEO has the control. So there's this idea of a separation of ownership control. Well, in a private company, that doesn't happen, because those that have the ownership are in control, right? The VCs, the founders are there. So the need for independent directors, at least from a theoretical perspective, is not the same in a private company than a public company. So there is a variation from how you think about the board as you start, one or two founders, the VCs start adding up as you raise new rounds. And so at what point do you add independent directors is not set in law, right? There's no requirement for you in a private company to have any independent directors, and it's more of a matter of practice. And I think that raises a lot of questions about board dynamics and what's the purpose of the board.
Great. No, that's a great kind of overview. And let me maybe turn it to you, Heidi. Could you expand a little bit on what role you do think independent directors play, insofar as they're not required, and you've been, at this for a couple of cycles at least. You've seen the good, the bad, the ugly. Maybe tell us what you think is the modern role of independent directors in private companies, particularly of the style we tend to see in the venture funded world.
And by the way, I have had 3 different types of board seats on private companies. One is as a VC investor, where we are also wearing the 2 hats, where we are both an investor and a director. One as an independent director, so where I'm completely independent and I'm just brought on, as an independent. And then twice I've even served as the designate for a board seat held by an investor. So I've been put in the board seat that was deeded to one of the investors, but I bring sort of an independent mindset to that. So,
by the way, there's one other board role in a private company, which is the founder or management director.
Of course. And I've been in that role too.
Right.
I was founder of a venture-backed company, and so I've been an employee founder director too. So I've seen it from kind of all sides. The first thing I'd say is I'm a huge proponent of bringing in independent directors early in the process. And here's why. The first reason is because if you're an entrepreneur, you're a founder, you're all of that, and you start raising rounds of capital, and those rounds always come in with preferred shares, those are stacked up ahead of you. And so it is said that investor directors wear 2 hats. We wear the hat of being supposedly an independent, care about all shareholders, including the common, and we wear a second hat, which is we have a preference to protect. And so there is an inherent conflict in being an investor director. What I like about independent directors in even small private companies is the vast majority of them are paid in all common shares. So either RSUs or stock options, but it's common. And so they are the closest to the entrepreneur on the cap table. And so first point I'd make is just independent directors are a great choice for entrepreneurs who want to make sure that more people than just them are thinking like a common shareholder. And second reason I like it is there are decisions that the board makes around the hiring and firing of the CEO, as well as compensation, which is a huge one, that I think sometimes, you're on the other side of the table when you're the VC, right? You put that money in, you're maybe stingy about it. Also, whenever there's a new fundraising event, and particularly if there's going to be a liquidity event, M&A, even secondary sales, things like that, it is really great to have an independent director who does not also have the conflict of that second hat, which, obviously, for example, if you're an investor like we are and a new round is coming up and the new investor presents onerous terms and we don't want to take them necessarily because they're bad for our fund, it's nice to have an independent director who looks at that differently. The last reason I think independent directors for private companies, particularly here in Silicon Valley, is a good idea is we still have a little bit of a diversity problem. And frankly, the venture capital industry has a bit of a diversity problem. And frankly, the tech industry on the entrepreneur side has a bit of a diversity problem. We're getting better, but we're not great yet. And so I really like the idea that you can use that independent director spot to bring some diversity to your board, to bring different perspective, to bring someone who's more, reflective of your employee base, your customer base, even your shareholder base. And so your non-venture shareholder base. So I'm all for them.
So I'm going to drill down on a couple things, but just to recap, we've got Delaware law that applies equally to corporations of a certain type, including private and public, but the differentiation is largely around listing standards, which are another component that public companies have to pay attention to, and some other issues. But the idea of an independent director is similar, if not required, on the venture funded or private company side. And so maybe what would be helpful is for us to dive in with a little bit more specificity about different stages or life cycle moments in the venture funded or private company space, and where independent directors might be, or all directors for that matter, be advised to pay extra attention, might have a differentiating factor, et cetera. So Evan, you want to kick that off? I'm thinking, by the way, just so you know, but go where you like, fundraising, down rounds, liquidity issues, secondaries, M&A, maybe pick a couple of those and say, okay, here's the issues, here's how independent directors should, or all directors should pay extra attention to private company.
Yeah, I think as you were telling the distinctions in Delaware law between private and public, one of the distinctions in the venture industry is how the funding occurs and what are the rights between the investors and the founders. And typically that's done through new classes of shares that are preferred shares that carry different liquidation rights and different rights. And that puts the preferred shareholder in a different position than the common shareholder. So typically in a public company, everybody is representing the common. But because in a private company, you have this type of financing that is done through phases and through preferred shares and different protective provisions, it puts the interest of the investors and the founders sometimes at odds, particularly in certain situations, like in some liquidity situations, if you sell the company, if you do a down run, if you do a recap. And I think that's where the role of the board plays a very important issue in terms of governance, because this is where the courts have said on multiple times already that there are dual fiduciary duties, right? And Heidi, you mentioned this, you wear two hats. And because of the law, what you have to do is to think about, well, if you're conflicted, can you make a decision in a certain way? Well, it turns out that if you have independent directors, you solve some of those issues because you don't have a conflict. And the courts will say, we will not second guess the decision of a board when they are independent. And you have to have a majority of the board to get the business judgment rule, which is a presumption by the judge that you are at ease, or you're in the best position to make the decision, and we're not going to do anything. Because that doesn't happen typically in a private venture-backed board, they can get caught up in this idea that you didn't have independent directors, you took a decision that was conflicted, therefore we got to go into what we call the entire fairness standard. We got to look into what was the process that you followed, and what was the price at which the transaction happened, and was that fair? And that takes a lot of time. It's very, very fact intensive, and courts will look into each director. And sometimes we call some people independent directors, but they're not really independent directors. And that is been very highly scrutinized by courts. And people love this. Oh, I'm an independent director because I'm not an employee, I'm not an investor. But it turns out that you've been in 5 other deals with the same VC. Maybe you have been paid in different ways. You share, that there's famous cases where people share a private plane, and therefore, that means that you're very connected with that person. So courts will be very, very thoughtful about, well, are you really independent director? There's been cases that have gone into the venture market. There are cases that go into private equity. There are cases that go into bankruptcy, where the role and who it gets called an independent director has different thresholds. And those thresholds, by the way, are different in public companies and by Delaware law. In fact, in public companies, you have bright line rules, right? Where you say, look, if you've been working for the company, if you've been paid by the company, if you're a family member, you're not considered independent director. Well, Delaware has its own way of looking at independent directors. And I think that's a very important dynamic, particularly in the venture industry. And I think there are cases, and the most important case is Trados, which is already 10 years old, but it's still very relevant in the venture industry because in 140 pages, the judge lays out what are the duties of directors, particularly when there is a conflict between common and preferred shareholders.
I'm laughing because Trados is definitely, if you want to read about how to do everything kind of wrong, there is sort of, that's a good one. But I think sometimes it really helps to describe an edge case to understand where those conflicts can occur. And by the way, if any of you independent directors want to work with me, just know ahead of time, I don't have a private jet. So that will not be one of your benefits.
The private jet comes into these stories.
Yeah, no, not that often. But anyway, let me, describe an edge case, because I think that's where you start to understand the conflict, where literally I, in my two hats, could vote yes on as a director and no as a shareholder. So let's imagine a situation where a company has raised money in stacked preferences. So you have every new round that comes in is senior to the old rounds. And so let's imagine further that I am down below some of the other rounds. So companies raised $30 million. They raised 10 from me, and then they went and raised 20 from someone else, and that 20 is senior. And you try to sell the company, and the company only gets an offer for 20 million. So that director wants to sell the company because they're going to make all their money. It might be the right or the wrong decision, don't know. But let's imagine I think it is the right decision with my director hat on. Let's imagine we've looked at the market. There's a whole bunch of reasons why. And it's the right decision, but I make zero and that person gets all their money back. I may oppose the merger with my investor hat on because I don't like the fact that I'm getting nothing. Now, frankly, I also believe in the sanctity of the preference stack, and I usually try not to mess with it. And so, again, I have seen people use blocking rights to muck with a deal that really is in the company's best interest, and I don't like that. And that's when it's great to have an independent director. But now let me throw a wrench in it where I think I would use those blocking rights. And in fact, I have used those blocking rights in another deal. Let's take that same case, and now let's add a management carve-out to it. So you have a management carve-out, right? The stock's going to be underwater. The only offer we got was 20. Well, I would have to make it a little more to make this thing work. So let's say the offer was 22 million. And so 20 million is going to go to that Series B investor. The last 2 is technically going to come to me. Now they say, let's put a carve out in. Let's make it a $2 million carve out, and let's just take it off the top. We'll just take it off the top. Well, the funny thing is, when you take a carve out off the top, who does it affect? The people at the bottom. So now imagine the first 2 million goes to the employees, then the next 20 goes to the Series B, and then we get 0. So in essence, the A paid for the entire carve out. So this is a case where we would potentially use our investor blocking rights and say, no, I'm not doing that. Let's pay each our fair share of the carve out. And I'm going to block the carve out. I'm going to block the M&A transaction unless you, Series B, are more reasonable about footing the bill with me. So that's a case where I would consider that I have a reasonable blocking right. And in fact, I would argue that an independent director would look at that probably and say, well, that's fair. So again, this stuff gets complex really fast. But the point I would make about all of this is when you have an independent director, they can be very useful in sort of looking at, frankly, calling out bad behavior when someone is purposely screwing up a deal. And again, I've seen so much bad behavior because I was a VC in the .com bust, so I could write a book on bad behavior. Mm-hmm. But bad behavior might even include somebody like not wanting to sell a company because they don't want to take a write down because they're out fundraising. Mm-hmm. And so they literally will totally screw the company they're investing in, even if it's not in their long-term best interest, because they don't want to take a write down right now. So, or then that could happen either for M&A or that could happen for another round. So the one other plug I'll make then for why it's good to have an independent on board. Sometimes what you do in these situations is you form a special committee of the board. And in private companies, very hard to get a majority of independent directors. Like we all like our board seats, and the entrepreneur likes their board seat. And so you already have 5 people around the table. You're not going to bring another 6 on just to give an independent majority. But what you can do is institute a committee of the board. And so, for example, for M&A or fundraising, you might institute a 3-person committee, and it's 2 independent board members and the founder, right? Or it might be, 1 of each, right? An investor, a founder, and an independent. But it gives that independent more weight. I'm curious, actually, ask the legal experts here, if you had a committee of the board that acted first, and they were truly like 2 independent directors and the founder, would that hold more weight legally?
Now, before we answer that, Evan, I want you, let's narrow, I love the kind of specific example, Heidi, that you gave, but let's make this one a down round that wipes out, common, and let's throw in the suspicion that there's some shenanigans around one of the VCs at the table who might be acting disingenuously for optics reasons, right? So let's and they're delaying perhaps, and so they're not, the lead investor is not going to be lead this time around. That's why you got the down round, because you're kind of desperate, and you're okay. You can create whatever story.
And the company's going to go out of business if they don't raise this round.
So
it's funny. I laugh about this because I've seen this.
Well, because this is, we don't have
exactly a real scenario.
Literally what happens. So walk us through that a little bit in terms of both the behavior we've observed in most boards over time and whether or not it's evolving, because that's relevant. And then there's a good legal answer to this. I mean, there's a pretty clear one, Evan. So start with what you've seen, and then let's answer the question, which I think is a great one.
So let me start with a concept that I think is very important. And I think Heidi will agree with this. If you have a bad investor, a bad VC, that's a huge threat for the viability of the company, right? If you have a bad director, period, right? That can kill a company quicker than anything else, right? So let's go back to the example that Heidi was giving. If you have 2 independent directors, what you should do is create a special committee of those 2 independent directors, because they don't have a conflict. But what you have to do is empower those independent directors. Say, look, here's a charter. This is what you got to do. You got to look into the deal. So let's say it's a down round. Look into the term sheet, hire financial advisors, hire your own legal advisors, and make a decision and take it, and you give us the recommendation. That's a perfect scenario. And if they recommend yes, and then you get sued, well, did the special committee make the decision in the right way? Were they empowered? Did they have time to review? Could they say no to management? Could they say no to the investors? Yes. Did they say no? Did they negotiate the term sheet? So here is another scenario. Imagine if you create a special committee, but let's say the VCs, a control group says, here's the price, and let's say it's $10 million. And if you don't do this, the company's going to go under. We have nothing. And if the special committee looks at it and says, well, okay, we're going to approve it. Well, that's pretty much a rubber stamp special committee. And what they have to do is actually look into the term sheet, understand the term sheet. And who are those people also matters. I've been in the positions where the people who were nominated in this special committee didn't know about venture capital, right? So how does, liquidation rights operate? How do pref stacks operate? And how much time did you negotiate a better deal, right? And I think that's very important. And the answer is, what you want to do with that special committee is to cleanse the transaction. So yes, you will have a lot of conflicts in Silicon Valley because it's full of conflicts, right? This is the reality of business. A lot of people know each other. You have VCs that have interest in certain deals. They're raising different funds. They know different people. But there is a process that you can follow that can cleanse a transaction, but it doesn't really happen that often and well. And that's a problematic scenario for companies, because then they'll say, well, this is Silicon Valley, we don't have all the money to pay for this. This is what Delaware wants in a public company, but we here move in a faster way. Well, but that's not really what the law says, right? And so I think that's the answer that I would give.
And if I can add to that, I agree with you that sometimes small companies push back and say, we can't hire, expert industry. One of the things most companies do have, though, is company counsel, And I defer to you guys on whether it's a good idea, but one of the things I would say is that's your first line, is going to company counsel, going to the CFO, like understanding the waterfall, i.e. where does the money flow in a stacked preference table? That's hard math, actually. It can be really complicated because some of those terms can have, ratchet provisions and multiple, and participating preferred and all sorts of bells and whistles that makes it like, I can't build those spreadsheets, but the company will have built that spreadsheet. And company counsel is there to represent the best interests of the company, not the particular shareholders. And so understanding who has the rights to do it and who can support you as an independent director and getting the information you need doesn't necessarily have to be the expenditure of a lot of money.
And let me add a point here, because sometimes company counsel can be tricky in a certain perspective, where they are defending the interest of the company and maybe deciding with the larger investors. Maybe they work with the same VC fund over and over. And so you got to be careful with that. And that's why the independence of the director helps more than counsel. And
or by the way, or they're siding with the CEO because they're actually sometimes they're inside counsel.
Yeah, and so that's something that people have to be aware. And you mentioned the management incentive plan, the carve out. Well, Trados was exactly that. The Trados scenario was a sale for $60 million, where $52 million went to pay for the liquidation for the preferred, and there was a carve out there of about $7 million. And that carve out was paid to the management at the time, who was given this incentive to sell the company. And the court said, look, be very careful how you finance the management incentive plan. In that case, all that money came from common, right? The common had nothing left over, right? So this is the scenario you were saying, is like, who's funding this? And why isn't there some level of, better fairness in how you design these management incentive plans? And I think that's an important takeaway from that case too.
I think that's,
by the way, without diving into the details of the case ad nauseum, it's worth noting, Evan, and correct me if I'm wrong, that essentially the total fairness standard was applied, which is no fun for the litigating parties, but in the end was essentially to be, to have been met. And so to your earlier point, the process, if there had been a more appropriate process, would have stopped the need to go through the entire fairness process and would have saved a lot of time, a lot of litigation. And it's kind of the joke is, it's kind of a hard way to win, to actually go through and survive.
Spend that money and that time. And actually, I want to throw two lessons that we're kind of talking about here, important for independent directors to understand. One is, as I said earlier, I don't like messing with waterfalls. I don't like, messing with other people's contractual rights to receive money. And I think it's Pandora's box. I think as soon as you start negotiating, saying, well, if I actually give this percent to the A who doesn't deserve it, are they going to vote for the deal? And, once you start opening that, I just believe that's just lawsuits waiting to happen.
Let me describe that so everyone following can understand what you're saying, because I want you to kind of give your observation on a foundation of what's really happening. So in theory, you have series A, B, C, and D. There is a definitive outcome given a certain amount of money that different classes and maybe even common will receive. That's the waterfall. So
contractually prescribed already.
It's contractual, it's specific. You build this fancy spreadsheet, the investment bankers double check it, and you understand you can put in 80 million, 82 million, 94 million, and you'll see who gets what. What you're talking about is, for whatever reason, maybe because it's 44 million and the CEO and the founding team's talking about walking away and you got to figure out what to do, or whatever the case may be, you're talking about the parties potentially coming together or strong arming each other through blocking rights and saying, okay, I know we agreed to this, but because of A, B, and C, we need to reopen that can of worms and we got to figure out how to reallocate. That's what you're talking about.
That's what I'm talking about.
Okay, great.
And my own opinion of that,
set up, please. Yeah.
Soon as you do that, why shouldn't everyone ask for a different amount? Why shouldn't, you want to give me 10 cents on the dollar? I want 20. And by the way, then who's doing that negotiation? Who's representing common? How does that all work? My own opinion, that is a can of worms. And I think as VCs, part of being a professional in the industry is understanding that when you took senior money and you're under that stack, you're under that stack. But I think number one, there's just understanding that, right? And when you mention, and I say independent directors should always understand what the waterfall looks like, what you have to ask about too, though, is generally speaking, someone will give you a waterfall and it'll say, well, the Series B will get this, the Series A will get this, the seeds will get this. But then you have to ask not by class, but by shareholder, because I might be in both the A and the B, right? And because I bought my pro rata in the B, but I have much more money in the A than the B. And so thinking with my total, my total shareholder, position, I may choose to vote against something that's in favor of the B, even if I'm in the B, because I'm also in the A. So it is important to also look at those things. But again, to simplify for independent directors, number one, you should understand all this stuff, right? And it is some heady math. But then number two, I would say there are some rules that will keep you out of trouble, right? One of my rules is don't mess with the cap, don't mess with that. But for example, when you do something like a carve out, you do have negotiating power to say, well, the carve out should be equally paid for by the people who are getting proceeds. Why should it come all out of one person's pocket and not the other? So when you're introducing new things, you most certainly can do that. And then the second thing, and I think this is the golden rule of selling any company, is run a thorough process. The number one thing that'll protect you in a liquidity event or a financing event is you took it to market, you were extensive, and this was the best you could do, right? And that is, I think, and correct me if I'm wrong, in the Trados case, I don't think it was really a very thorough process. I think that it's super important. And frankly, I think it's the reason why sometimes you hire an independent, a boutique banker, or you work with an independent or a law firm or somebody to help you really design a process, run the process, and ensure that you've turned all the stones. Because ultimately, the thing that protects you most is it was the best offer on the table.
The other lesson from Trados is, you're correct. Of the 140-page memorandum, 100 pages were how bad the process was. And then when they get to the price, they said, look, nobody was going to pay more than $60 million for this. And the value for the common was essentially zero, because they had so much liquidation preference stack that there was no way they were going to get more than that, right? Because as the common would argue, look, why wouldn't we continue and maybe roll the dice and maybe 2 years from now sell for 80 million and then we'll get 20 million, right? So who gets to make that decision is the board. And the biggest takeaway from Trados is that the board, when there is a conflict of this type, they have to think that the fiduciary duty is owed to the common shareholder and not the preferred shareholder, because the preferred shareholders have contractual rights, but the fiduciary duty from state law is owed to the common shareholders, who are the residual claimants. When you clean out everybody else, all the fixed claims and preferred, that's who you have to think about, right? And that has an infinite horizon. And I think that's what a lot of people still struggle with as a director. Oh, I owe my duties to all the shareholders. Wait a minute, in a venture-backed situation, you technically owe it to the common shareholders. And that's something that people struggle, but it is the holding in Delaware, and you got to be thoughtful about it. So what does it mean in essence? When you make a decision, think about what is the impact of the common? Can we do something better? Should we actually extend and do another sale? Should we do for 2 more years? Should we do a carve out? And so one of the takeaways from this case is people are doing more carve outs for common, I think in a way as well as an insurance, right? Say, well, because if in Trados they would have received $2.5 million, whatever that was taken away from the management incentive plan, maybe we wouldn't be in all of this situation, right? So, and I've heard other VCs, Heidi, who said, well, the carve out should be, all the way to 30%, right? And these are VCs that are talking. Now, what is the real number?
First of all, as you know, you taught me this because I thought it was all shareholders, not just the common. And by the way, if the company's insolvent, then your first priority is debt, right? Not even debt and employees, not even shareholders. So this gets, everyone should know the basics. And now I know the basics thanks to you. But I'm curious about this because, so me with my, hat on, when I do a carve out, you're taking money from a group of people who are owed it contractually, and you're giving it to other people. And so there has to be a justification for that.
Well, here's the
And for
justification is
management, for management carve-outs, the justification is I need you to stay and conclude the deal. But what is the justification for carve-out to common? And what would be an appropriate number? I mean, who's going to negotiate that? You got 100, 150 common shareholders, all different opinions. I mean, how do you actually get that done?
Well, the problem with it, it's a very hard issue because, first of all, we don't have a window to the board, right? So many times what happens is the founder who represents common in the board takes a payment himself. Mm-hmm. So the rest of the common get nothing, but he's got a special deal. So I always worry about the employees, right? Who have all these stock options that are essentially nobody's like going to bat at them in the board. And they get washed out and completely diluted. So
and let me throw in one just so people can think about the stakeholders. So in the eras of old, 15 or 20 years ago, you had employees who had vested options or even vesting options, but not shares. But fast forward to current times, and you may actually even have employees who started 11 years ago, left 4 years ago, were lucky enough to be able to exercise their options, which were fully vested into shares, are now shareholders, common shareholders, and no longer affiliated with the company. So you have a wider diaspora of genuine legal stakeholders, and then to a certain extent, other stakeholders. I want to turn your answer, so I want you to continue to say what you're about to say, but I want to make it more contemporary by maybe describing a down round in sort of dire circumstances. And let's say I'm going to amalgamate from a bunch of biotech companies, right? Not a happy time for biotech. And you know, it's a negotiating of a third round that started 6 or 8 months ago. And typical biotech, it's a anti-cancer agent. So they're in stage 2 trials. The costs are ramping up. For whatever reason, I'll take an example from the news. The fund, the lead investor is discontinued. They decided not to raise another fund, and they're kind of wrapping up, right? And the entrepreneurs didn't know this 3 years ago, but it is what it is. And they are still on the board though. And now they're raising, and they've brought in a new lead potential investor, but it's pretty tough terms. You know, it's a lower valuation than the last round. And there's a concern about employees. So they want to force a 20% option pool. They want to create some special carve outs. They want to really just cram down some of those early investors. They're kind of not punishing, but they're not treating nicely this VC who left everyone high and dry. And that VC can block this or drag it out for a long time. So this is the kind of conflicts I think that we see now, where entrepreneurs who they're like, what? So tell me, maybe both you and Heidi, as a practical matter, the way board meetings happen, the way notices are given, the way these things are negotiated, how does that play out, and how should it play out? And what does the independent director do? So down round, new lead investor, cram down, current VCs, you know, at the very least, dragging their feet because they just don't want that to happen, and it's just putting the company in jeopardy.
I love it because there's a real case again about this. It's called Basho. It's from 2018, and this is a case. I think it was in Michigan or somewhere, not in Silicon Valley. And what happened there is you had a VC who had very strong terms, and basically pushed out potential third investors and was driving a down round. And because of his strong rights and trying to navigate himself the funding of the company, he ran the company to the ground. And no other investor was open to investing in this company. And this investor was found to have breached his duty of loyalty and had to pay $20 million in damages because of the situation. So there you have a real case of somebody who, used his rights in a forceful way and breaching his duty of loyalty only for himself and not thinking about the company as a whole. Now, it's very different to talk about an investor that is an inside investor leading a new round and an outside investor. Typically, if you get a new outside investor to lead the round, it's arm's length. So he's going to put a price, and that's much cleaner from a governance perspective because it's a third party. He's going to negotiate its arm's length. If it's an inside round, the danger is that person may want to get a new deal that is much better for him or her. And what can happen is that the new down round has terms that are very favorable for the VC. They wash out whatever cap table exists, and they can reprice. If they have anti-dilution protection, like a full ratchet, they can reprice their prior round to the new price. And so you start with having maybe 10% of the equity, and now with this new round, inside round, you now have 45% of the equity at a much lower valuation. Now that's very problematic. That's why when you do an inside round, the fiduciary duties are heightened, and the court will be will look very closely on how and who designed the process and what price you paid. And I think that's the difference between having an outside investor and an inside-led round.
But if
So let me ask Heidi.
can I just jump on
Yeah,
that
please do.
to say,
Please do.
okay,
Yes.
because I mentioned earlier when we were prepping for the call, I said, what I worry about is we say so much terrible stuff that can happen to you as an independent director. Nobody's going to want to be an independent director. And I can tell you in the 25 years I've been a director, I've only been served once and the case was dismissed. Now, there have been a few class action suits of the common that also got dismissed because we had, followed the right process. But the point is, I've been doing this for a long time, and I've never paid a personal penny for anything happening. So please don't get off this call and run screaming from the building. But that said, I think that what you should be taking away from this, what I certainly take away from this is A, this stuff's really complicated. B, there is a simple way to understand what's going to happen, which is ask the math people, the CFO or whoever, say, show me the before and after of this financing. Show me the before and after of what happens if we sell for this price versus that price. So understanding, you don't have to understand the complexity of the math. You actually only have to understand the payouts, because that will help you understand who's biased or motivated, because you're going to see that different people make very different money or have very different residual value based on how these terms play out, because terms are super complicated, and every term that exists was designed for a reason to benefit somebody in the past, and that's why it's there. So there's all sorts of ways to do this, and let's face it, VCs have a lot more experience doing it than either independent directors or even the company itself, the founders, because they usually only have one or two or maybe three companies worth of experience, and VCs do this all the time. So the final point I'll make is if you put a good process in place, if you thoroughly look at the options, if you as an independent director understand this stuff enough to at least understand why someone would be exhibiting bad behavior, you can call them out on that bad behavior. And I think that this is one of those things that, and we're going through another period in time where lots of people are learning this, because there's a lot of recaps and cram downs and down rounds and all sorts of, semi-bad outcomes happening. And by the way, why do those happen? Because the vast majority of these companies cannot get to cash flow break even without more money. So they don't have the option of saying, why didn't we just keep going? There was no keep going option. There's, you either need more money or you need to sell. But at the end of the day, lead, follow, or get out of the way is my feeling about as a VC, right? We either should be participating in the solution. We should say, we don't have faith in this company anymore. We're not going to participate in the solution. Leading is hard when you're an existing, to the point Evan made, because you are conflicted with your own prior position. Not to say you can't do it, but it better be very scrubbed by a process. And then, get out of the way is, in my opinion, and I say this to my partners in the .com bus, we can either be the crusher or the crushee, but something's going to get crushed here, and it might be us. And sometimes if you're not going to believe in the company reputationally, the best thing you can do is say, look, I'll get out of the way. You guys do what you want. We're in the risk business. Almost half of our deals don't return the capital we put in. That's the business we're in. And so to be assholes about stuff is a bad idea. You may win the battle but lose the war, right? You may twist somebody's arm and get your couple million back, but no entrepreneur is going to want to work with you anymore. And so I do think, again, going back to independent directors, which is what we're talking about today, as an independent, you have the ability to call out that behavior, right? It is one of the most powerful things an independent director can do. And reputationally, you're going to be in hot demand for other boards if you play that role in a company.
Let me jump in real quick. I want to hang on a minute. I just want to address it. We've got about 5 questions stacked up that I want to kind of get to directly and indirectly. And I want to riff on Jack Lazar's comment. Thank you, Heidi. Just to make a point about not discouraging, but encouraging care and diligence for people contemplating being independent directors of private companies. Pure coincidence, today on my flight early this morning, I happened to sit next to a pretty well-known CEO chair of a publicly traded company in Silicon Valley who told me a story about being recruited to be on a private company board. He served on several off and on, and it was a VC he knew, and he said, we really need your help. And he was recruited onto that board. They promptly made him chairman. And the tale that he tells is, I really should have done a lot more diligence. There was a battle between board members. There was a disgruntled VC from the last round. Litigation ensued. So his takeaway was 2 points. I think it's really relevant. One was engage in diligence about the why, the what, and the dynamics of a private board. Wonderful opportunities, but there can be risks, and there's oftentimes a story. You should at least know it before jumping in with 2 feet. Secondly, he found the D&O coverage to be a little thinner than he had wished. So look at the D&O, look at the directors and officers insurance to make sure that it satisfies you, and it has advancement of fees and the like. There's probably a session we'll do at a different time. And once you do those things, then you can make some smart judgments. There's tremendous opportunity and a lot of good that can be done if independent directors embrace private companies and can move into them. So here, I want to do a couple questions. One related to what both of you have said. Evan, you said sometimes VCs and or independent directors even don't know X, Y, and Z. And Heidi, you gave some examples, even yourself, though yours is more benign than most, where you're like, oh, here's a nuance I didn't know. We got a question that went something like, a lot of first-time board members are entering the space as private company directors, right? PE or VC or otherwise. And yet there's not a lot of depth of understanding education. What should or could directors do to ramp up for that purpose? And I will brag for Evan Epstein, who, while we were both at Stanford and he was executive director of the Rock Center, spun up the Directors College for Venture Capitalists. So there's some good examples of exec ed out there. But Heidi and Evan, could you give us like 1 minute each of, at the very least, people contemplating this should do the following and include VCs? Because, by the way, sometimes I run across brilliant VCs who are, how to put it nicely, not so clear and deep on the governance side. Like they're great VCs, but maybe not so much governance. So what should people
There's no
do?
exam a VC has to pass.
Right.
Neither a good investor nor a good director. So.
Yeah. So here's a few things. So Dan, you mentioned we started this program at Stanford 10 years ago. Stanford has for 30 years this Directors College for Public Company Directors, and a lot of people would approach us and say, "Hey, I'm joining this private company board. Do you think I should go to Directors College?" And we were like, it's so different, and the issues are just completely separate. And we created this program that was great, and we did that for like 3 or 4 years. I left, and I'm actually restarting the program at UC Law SF.
Awesome.
With Cooley. Yeah, with Cooley. So
someone's going to walk into where I am at Stanford right now, and they're going to hit me with a stick for bringing this up. But go ahead, Evan.
Well, we it's in March 8th, I think is our date. We partner with Cooley to do this. Rachel Profit, who's an alum of the school and the new CEO of Cooley, is very much understands the problem of having directors in venture-backed boards. There's a lack of education. And Heidi, you've been on boards in Silicon Valley for 30 years. And the reality of this is that people tend to know a lot about venture capital, but all of this governance that we just talked is very narrow, and there's very few people who really understand what goes on. Now, that is the 5% of cases that get litigated. The truth is that 95% of cases are not going to get litigated, but there is a segment that there's a lot of bad behavior that never sees the light of court because these cases are private. It's not public. You don't see what happens. A lot of them are settled out of court. There are NDAs. And so I think, what Delaware has been clamoring is, hey, Silicon Valley, add more process, add more independent directors. Now, let me ask you, Heidi, why do you think more independent directors have not been added in boards of Silicon Valley companies if that would solve one of the problems? It's not a panacea, but it would help more, right? At least solve.
Well, I think they're just undervalued by both the investors and the entrepreneurs. And I think this could be entrepreneurially driven, that as an entrepreneur, if you understand that independence can really help you, that going and approaching that would be a really good idea. I just think for some reason, it just didn't get baked in the way it should be. So my first plea is to entrepreneurs. I think the second thing though is it's to the point of like, it's not as risky as you think it's going to be. You know, the flip side of that, part of the reason it's not as risky is because the investors have a lot of rights and they can exercise those rights. And, you know, the vast majority of companies that sell in a fire sale never even clear the preferences, and they don't get sued because of that, because you do the diligence, you go run a process, nobody shows up. It is a likely outcome. So it isn't that every one of these is going to end in disaster. And I would say common sense is really valuable in just when you're an independent director. And also the, you know, I say this to people all the time. You want to know what the number one reason is that companies run out of, you know, go out of business? They run out of money. Number one reason, only reason actually, because as long as you got money, you're going to keep trying. And so as an independent director, the thing I would say is watch that gas meter, because the way you get into trouble as an independent director is that the company, you know, everybody wants to play out the clock. And then you get into the, you know, into the zones where you're not going to be able to get an outcome. You get the zone of insolvency. You leave employees holding the bag. Those are the cases you're going to get in trouble. Generally, if you don't run out of money, you're not going to get in as much trouble. And so I would just say that on the point of education, I was fortunate enough in my prior VC firm to be partners with a guy named Brad Feld of the Foundry Group. Brad has written some excellent books. One is on being a private company director. One is called Venture Deals, which is a slog, but if you really want to know how venture works, it's a very definitive compendium he wrote with Jason Mendelsohn, who is a lawyer, and Brad is a great investor. And so if you go look at books by Brad Feld, he has written a number of books on the topic of small company management, private company directors, and that sort of thing. So
well, and that book that he wrote 10 years ago, Startup Boards, there's a second edition now with Matt Bloomberg.
Matt Bloomberg.
Yeah, who's talking on this topic, and I think it's a great book. We had a prior session with him with SVDX as well, and so I think that's a great book. And there's another book that I recently read, some VC and entrepreneur from New York. It's called Founder versus Investor, and it's interesting because they have the point of view of the VC and the point of view of the founder. And it's what's really interesting about that. Nothing of it is grounded in law and what really happens, but it's the bias of, if the founder says the board has zero value. Why have a board? This is like completely destroys value. You know, it's a waste of time. And the founder and an investor says, well, the board is there to provide oversight for me as an investor, which is really interesting too. So there is a lot of education, as we've been saying, that is lacking in this industry. And I think people have to understand that if you have a good independent director that is can provide a lot of value for the company, but also some level of process that is much cleaner in terms of, you know, having risks down the line.
Hey, Evan, I'm going to point out that we will definitely in the follow-up include the references to those 3 different books and then a couple of other things that we've said. So don't worry if you didn't catch it and you're listening, we'll make sure you get that information. I want to segue to a couple of the other questions before we run out of time. So one, I'm going to answer, which came from an anonymous attendee saying, hey, Heidi mentioned the zone of insolvency thing. Like, can you dig into that? My one answer to that is that deserves its own treatment. Zone of insolvency is highly complex, very contextual. And my one observation would be that retaining counsel, specialized counsel sooner rather than later. I've never had any board or anybody say, oh, I wished we hadn't retained that counsel as soon as we did. It's always the opposite. So for zone of insolvency, it's very difficult to untangle, but related, and you made a mention of this, Heidi, about cash. We got a very pointed question that was something like, listen, you got a company, you got some founders, you got common shareholders, you got VCs, and they're all just kind of hoping, and hope is not a strategy, right? Like, and there they are, you know, drawing down available, you know, cash, you know, runways running out of length. What should the independent director do in these situations where, you know, it looks like people are irrationally holding out for some sort of miracle? Is there a particular role for independent directors where they aren't, you know, biased or vested in the ways that sometimes other different players are?
Oh, I'll just give you, I mean, we don't have much time, so I'm going to give you my rule, and it may be controversial. If the company you're on the board of has only a year or less of runway, you already should be speaking up. If your company has 9 months or less of runway, you should already beginning a process to be sold. And if your company has 4 months or less of runway, and runway doesn't count debt, right? Runway is, asset, the money in the bank minus the liabilities on it, and payroll, debt, things that you have to pay if you got a business. I would resign from that board as an independent. I would speak early, speak often, and if nobody's paying attention to you, I would actually get off that board. I don't know, Evan, Dan, how you guys feel about that, but I don't think it's worth the risk, because again, all the problems happen when you have bad process and when you run out of money.
Yeah, and Evan, maybe if you could answer part of that, but maybe go in another piece, which is, we got a specific follow-up question to that one, which is, hey, how does this, play out in the context of having a bunch of safes or convertible notes? That wasn't the question, but like safes, in place as you're kind of having these problems. What do you do?
Well, in a safe context, they're still not shareholders, so you don't have any rights at that stage other than the safe itself. So I think what we're talking about is if you're in a board and you represent the shareholders, and resigning from the board is important. I mentioned, I think last time in the last webinar, this case of the director in Theranos, who was the independent director who just wasn't getting the information from Elizabeth Holmes. And, he went back to the chair of the company, said, look, she's not giving me this information. And turns out the chair, Don Lucas and Elizabeth Holmes, said, I'm sorry, this company is not for you. So that director said, look, I'm resigning. And it shows that he was trying to do the right thing. So as an independent director, you should do the right thing. And if they don't listen, if they don't take your opinion, then sure, maybe at that stage, there's nothing else you can do but resign. But you do have a fiduciary duty to protect the shareholders. And so you should try to do your best in terms of really asking the questions and making sure that it's on the record. Remember, if things go south, the minutes are really important, and so people will look into that.
And email, which is discoverable.
Email is huge.
Hurt you or help you.
E stands for evidence and evermore.
E stands for evidence.
So here's my final question to you, 30 seconds or less. What one thing, and you can pick either side of this, should you just not get hung up on because it's getting too much treatment? It's in a red herring. So stop worrying about that. Pay attention to what you said earlier. Or alternatively, is there something on the horizon that you think is an underappreciated or sleeper issue that people should be paying attention to in the context of independent directors or private boards? So Evan, you get to go first, and Heidi gets to wrap up, and then we're done.
Well, I do think that in the current environment where you have so much market destruction, right? Like 60% of all the companies are getting repriced. There's a lot of down rounds. A lot of that is market driven. And so I think that as long as you design and now it's where the board has to do the real job, right? In the last 12 years in the board, when everything was going well, nobody cares about governance. But it's in this environment where things are tough and you got to make decisions that you got to be scrutinized. So as long as you run a good process and you think about it and you actually have independent directors, or you do a process where you have a special committee, then it's going to be fine. But you have to do your job. And I think we're going to see a lot of companies, both unicorns and private companies, that are going to go under or going to get repriced, and just like a lot of people are going to lose money on that equity that was priced in the big 2021 2019, that there was this run up and prices were all over the place. So I think we should be seeing more governance issues coming through and more than before, just because times are harder and boards have more work to do at this stage.
Great. Heidi, I'm going to
last one, 30 seconds. I know we're out of time. The one thing we didn't talk about that I think is important for independent directors: structured deals in general are bad for startups. And yet structured deals.
Explain structured deals.
Structured deals. I come in and I say, I want my money to be senior. I want to get a 2x multiple. I want my money out first. Creating scenarios where private investors have vastly different outcome playbooks creates problems for the future. And yet, why do entrepreneurs want to do that? Why do current investors want to do that? They don't want to mark their deals down. Valuations are great at the top of the paper. They want to brag about their up round or their whatever. They don't want to take pain now. And so they put structure in because entrepreneurs are optimists, and because VCs don't like to write down deals or face reality until they have to. By and large, we all just avoid pain. as an independent director, the number one thing, if you have any ability to do that, is try to influence transactions, fundraising transactions, so that the investors are as much on the same page as possible, like pari passu instead of stacked. Again, you can go look these things up. If you don't know what they are, you should know what they are. Pari passu, everybody in the same boat. We all get a portion of the proceeds. Stacked, I get all mine, you get none of yours. That's what creates governance nightmares.
So if this were a movie,
called dirty term sheets too, by the way.
Yeah.
Yeah, so if this were a movie, this no structured deals admonition would now clue in that there's going to be a sequel to this movie, because we're going to have to do something on structured deals. But we've gone over by a couple of minutes, but I just couldn't resist it. I want to thank you so much, Evan and Heidi. This has been fantastic. Thank you for those who participated and asked questions. And Nancy, as always, thank you for your help and for the sponsorship that we received from all of our various sponsors. Wonderful.
And thanks for your leadership, Dan.
Thanks a lot. Bye-bye.
Thank you.
Bye.
Bye.